In 1 year, Peloton has gone from a market cap of almost $50 billion down to approximately $12 billion. At the same time, it has laid off 2,800 employees, its founder and CEO stepped down, and its first factory is no longer being developed. So, how did this company go from being the darling of Wall Street to fending off angry investors, calling for it to be sold? Join us as we break down Peloton to find out how it got so popular, what led to its spectacular crash, and what 3 lessons you can learn from its mistakes. Just want the lessons? Skip to the 3 lessons from Peloton chapter below. Peloton, the company behind the premium exercise bikes and treadmills with internet-enabled screens and an app that beams live and on-demand exercise classes into its users' homes, is the brainchild of former Barnes & Noble exec John Foley. Bikes start from $1,500 to $2,500. Its treadmill starts at $2,500, and access to classes costs $39 per month. So it's clear Peloton is targeting a premium market. Foley came up with the idea for the company after noticing he enjoyed instructor-led classes more than exercising on his own, but he often struggled to attend the ones with his favourite instructors because they were too packed or too expensive. Instead of seeing a problem, he saw an opportunity to bring his experience home. In the beginning, growth was steady, and by August 2018, Peloton had sold over 400,000 bikes and attracted $994 million in investments, giving it a valuation of more than $4 billion. An impressive result that was fueled by a secret formula. Peloton, by combining high-quality home fitness equipment with live classes presented by top instructors, the company created a cult-like following, with some superfans going as far as tattooing its logo on their bodies. It even found favour among celebs like Hugh Jackman, Olympic champion sprinter Usain Bolt, and billionaire Richard Branson. Amidst this hype, Foley took Peloton public in 2019 at $29 per share, giving it a $7.7 billion valuation. However, shares closed 11% lower at the end of trading. This poor performance was in part due to its status as a loss-making company. At the time, even though revenue had doubled to $915 million over the previous year, losses had quadrupled to $196 million in the same period. This loss-making status would be one of the reasons their stock collapsed in early 2022. But let's not get ahead of ourselves. Before the collapse, Peloton would see a massive upswing in its stock price thanks to pandemic-fueled growth. With gyms closed, its bikes and treadmills were perfect for people that were looking for ways to stay active at home. This demand helped Peloton achieve a 172% surge in sales and more than 1 million people subscribing to its streaming classes in the 4th quarter of 2020. Everything was looking great for John Foley and his team. However, the pandemic had a severe impact on their supply chain. The company was struggling to meet demand, leading annoyed customers to vent their frustrations online. As a result, the company invested more than $100 million in solutions aimed at reducing manufacturing and shipping times, and committed $400 million to building a factory in Ohio a year later. This hype around Peloton helped its stocks rise more than 440% to more than $170 at the beginning of 2021. But this impressive growth wouldn't last for long due to several reasons. First, as the world and gyms started reopening in 2021, demand for at-home exercise equipment dropped. Secondly, saturating a limited market. Most people that wanted a Peloton bike or treadmill already had bought one and weren't in the market for another one anytime soon. At the same time, Peloton was facing criticism after it initially rejected a call by the Consumer Product Safety Commission to recall its Tread Plus treadmill after several reported accidents. Finally, in January 2022, CNBC reported that, according to leaked internal company documents, Peloton had paused production after the decrease in post-pandemic demand had left the company with excess treadmills and bikes in their warehouses. The result was an 80% drop in share price to $24.22, well below the $29 share price of its stock market debut. This led investors to accuse Foley and the board of management, calling for him to be fired and Peloton to be sold. While rumoured, potential acquirers include Amazon, Nike, and Apple which helped Peloton's stock recover 30% of its value. Its most recent moves seems to indicate that it is still trying to remain independent. In an effort to save at least $800 million in costs, the company laid off 2,800 employees, including 20% of its corporate positions. Foley also stepped down as CEO, taking on the role of executive chair instead. His replacement is Barry McCarthy, the former chief financial officer of Spotify and Netflix. Other efforts to minimize costs include reducing the number of warehouses it operates and working with more third-party providers for deliveries. Finally, it also announced that it is winding down the development of its Ohio factory. Peloton's rapid rise and fall has 3 great lessons for entrepreneurs. First, always under-promise and over-deliver. Never the other way around. While Peloton's CEO had no control over supply chain issues during the pandemic, he did have control over how they managed customers' expectations. Whilst customers were promised delivery times of 7 weeks, many received a simple notification stating that their shipment was delayed for another 7 weeks with no explanation. For customers that paid in the thousands for their product, this felt like a slap in the face. The result was a flood of unhappy customers posting online. Foley missed an opportunity to give consumers realistic delivery dates and delight them with an early delivery when the supply chain issues improved. Second, hope for the best, but plan for the worst. While Foley couldn't have predicted the pandemic and its effect on Peloton, he assumed this growth trend would continue. This left the company without a strong backup plan in place, which resulted to be a recipe for failure. Peloton's products target a niche market. Thanks to the pandemic, most of their target audience had bought their bike already. Despite the world reopening in 2021 and demand for its products decreasing, the company continued with its efforts to expand manufacturing, leading to unsold products at warehouses. Finally, be like water. For a company to be successful, it needs to rapidly adapt to changing circumstances. Too often, Peloton would be too slow to react to internal issues. For example, rather than immediately recalling its treadmill, Peloton pushed back, resulting in bad publicity. Peloton underestimated the pandemic's impact on its growth, leading it to overinvest in products with waning demand. The result was a dramatic decline in stock price that triggered immediate action from the board. The first step was laying off 2,800 employees in order to reduce costs and appointing a new CEO in attempts to save the company in the eyes of investors. The lessons we learned from this story are universal. Although we analysed Peloton, every business can learn something and relate the learning to their own situation. If you liked this video, please let me know in the comments. And that's it for another business breakdown. See you later.